Hi. Most people think that there are only a couple of options when it comes to financing a home purchase here in Montgomery County and across the DMV. If they think that, they're still stuck in the days of post-financial collapse in the middle 2000s, wherein essentially it went from tons and tons of options, many of which were not viable, to basically 20% down, or if you didn't have 20% down, you had to rely upon a federally backed program like FHA. Since then, things have changed, and there are at least a half dozen options that are in fact viable that can work for you if you're ready to make that home purchase. And I'm going to go over these now with you. Fact of the matter is that you have to choose wisely, because if you make the wrong choice and pick the wrong program, you could cost yourself not only money and time, but you could lose the transaction in the first place and not be able to get the house that you really want. Now, what you want to do is recognize that each of these financing options is a tool. It's a tool to be used to get you the best option, to get the best price, to get the best terms in your transaction. They're tools. There are varying reasons why one can use one tool as another, just like any tool has its varied uses. So just keep in mind that they are a tool to get what you want. And what can dictate which tool in this particular setting has to do with your personal profile, your business profile, your financial profile, what you have in the bank, what you expect to save over time, and credit scores and that sort of thing. But they are tools, and they depend on you and your ability to use them in order to put them into play. So the first one we're going to talk about is called conventional loans. Conventional loans are those loans that are backed by the financial institution. They are gauged against Fannie Mae and Freddie Mac guidelines in order to make them, and they are ultimately, in most cases, sold on the secondary market after settlement so that that lender can recover what he's lent and can make other loans to other borrowers over time. After the financial collapse that occurred 2007, 2008, there wasn't much of an option in terms of down payment for conventional loans. You basically had to have 20%. And if you didn't have 20%, you would have to look for other options. Now, there are different programs for different borrowers, depending upon their qualifications, that can range in down payment from, in some cases, no down payment, but typically from 3% to 5%, 10% and 15%, all the way up to 20%. Now, you got to realize that if you're borrowing with 20% down payment, that's the only way to avoid mortgage insurance. If you have less than 20% down, there is going to be a mortgage insurance component. Now, that can either be the actual premium being paid on a monthly basis, or it could be built into the loan rate, or it could be paid as a lump sum at some point. But there is going to be some sort of private mortgage insurance component in a loan where you don't have 20% down, and you're going to have to factor that in. If you keep the house long enough and keep the mortgage long enough, it may behoove you to build that mortgage insurance component into the rate. If you plan on selling it sooner or refinancing the loan sooner, then sometimes it's better to pay that as part of your monthly payment. A couple of key points to note with regards to conventional financing is that, as I mentioned, private mortgage insurance is required with any down payment less than 20%. However, once you reach the point where you do have at least 20% equity, that mortgage insurance can be removed, which is different from FHA, which we'll discuss in a little bit. Also, there's more flexibility with conventional loans with regards to the property condition, and typically you get the best rates with your credit scores above 680 and up into the sevens and beyond. So if you're a stronger borrower, you have money to play with, conventional is typically the best way to go. Benefit of conventional loans, even if you're going with a lower down payment, is that some sellers and some agents still look upon FHA and VA and other government-backed programs as being less secure, more risky than conventional. This really isn't the case much anymore, but there is still that perception. So if you're in a competitive situation and you're up against several other borrowers, you may be at a deficit if you don't have a conventional loan, even with a lower down payment. So keep that in mind, because it can make a difference on getting the property in the first place or not, contingent upon the type of financing you're going to be using. Now, what do you do if your credit is not so good and you don't have a ton of cash to get yourself the best rate? Well, that's where FHA comes in. FHA is not just for a less qualified borrower, but it does have a lower credit score threshold, which can be a benefit. And it also does have a lower down payment requirement. You can get an FHA loan for as little as 3.5% down. You can put more, obviously, but it can be done with 3.5%. And the credit score threshold is lower, and it can go as low as around 580. Now, not all lenders will go along with that, and some lenders have their own credit score requirements. But as far as FHA is concerned, it is possible to borrow with a credit score that's not quite stellar and can be a means to get you in a house while you do get your credit repaired and you get a house to actually enjoy. Another aspect of FHA is that there is a bit more forgiveness in the debt to income ratio. So if you have a little bit more debt than would qualify you for a conventional loan, FHA may be the option for you. Now, the trade-off for FHA is that there is an upfront mortgage insurance component. Plus, there is a monthly mortgage insurance component. No matter how much of a down payment you put down with the current rules on FHA, there's always going to be a mortgage insurance component. And there is no point, generally speaking, where that mortgage insurance can go away once you've had the property for a while, even if the equity in the property goes up. So if you do get FHA and you plan to keep the property long term, you might have in your sights to refinance later so you can take advantage of getting rid of the mortgage insurance. But the only way to do that, generally speaking, right now is to actually move to a conventional form at some point down the road when you do have the equity and or the credit scores to do that. Another thing to factor in, which sometimes makes sellers and other agents a little bit skittish, is that there is a degree of property condition part of the guidelines for an FHA loan. They will look at certain things like peeling paint, exposed lead-based paint, damaged windows, plumbing leaks, moisture problems, and many other things. They will look at that. And sometimes when the appraiser comes through, they will require that those things get fixed prior to closing of the loan. And that can jeopardize, in some cases, the transaction because the seller doesn't want to have to fix anything once you're through the inspection process and all that, then to get notified that there's something else to fix. So some people will get a little bit worried about an FHA loan. It is not nearly the issue that it used to be because properties are generally in better condition now than they used to be, but it still can come up and it still can cause a problem. So it's something to factor in. The property condition of the property that you're going to buy could be affected by FHA guidelines, and the loan could fall apart because of those guidelines. So it's something to keep in mind. So if your credit scores are not quite as stellar as you'd like to be, and you don't have as much available cash as you'd like, FHA can be good as far as an option goes to making that purchase. One thing is that generally speaking, FHA rates are lower than conventional in most cases. And so that can offset some of the higher costs involved in mortgage insurance and that sort of thing. All right. And then we have VA loans. These are loans that are backed by the U.S. Department of Veteran Affairs. If you had prior service or existing service in the military or one of its branches or some other categories, and you qualify for a Veterans Administration loan, this can be a very, very, very good option for you. And in many cases, there are lower down payment options. In many cases, you can even borrow to make the purchase with zero down payment. So if you're a veteran or qualify because you're a connection to a veteran and you can get a VA loan, this is definitely something to look into to get the best terms for you. Now, the downside of VA loans is similar to FHA, is that some agents and some sellers have a little bit of worry about it. Because we're trying to protect our veterans, the VA requires that the property condition be looked at. There are things that the appraiser will flag in a VA inspection that could cause repairs or fixes to be made, which the seller may not want to do. There used to be a case of VA loans taking longer and having more pitfalls during the underwriting process. That's less an issue these days, but some people still have that misperception about VA loans. Interest rates are very competitive. They're some of the best, and there is no private mortgage insurance component. There is a funding fee, but that funding fee can be worked into the terms of the loan and borrow and become part of your monthly payment rather than something that has to get paid up front, although that is an option as well. VA loans are arguably one of the best mortgage products available if you qualify. So if you do, you should check into it, see what the terms are, see how it works out for you, and then discuss with your mortgage professional and your real estate professional how's the best way to proceed. Because the downside of VA loans is that, like I said, sellers and agents still are a little squeamish about VA loans, and they may pick a conventional loan or some other type of financing over a VA loan because of those misperceptions. So if you're active duty, If you're a veteran, if you're the spouse of a veteran and you qualify for VA loans, this is often one of the best programs for you to get. And if you can take advantage of it, you should at least look into it. Now, some borrowers will not be able to really qualify for the types of programs that we just talked about. So there are state and local backed programs, Maryland, Montgomery County, that can help those who are financially strapped cash wise, have income and could qualify, but don't have the necessary cash. They don't have the money for closing costs, and their credit scores are a bit challenged. So there are programs such as the Maryland Mortgage Program, which offers down payment assistance, which can often be around $10,000. There are competitive fixed rates. They often coincide with FHA programs. And they do have, in many cases, first time buyer incentives. Now, the downside is that there are income limits. So not everybody can qualify for this. There are purchase price caps in many cases, and the rates are often higher than they would be otherwise because you're taking someone who's a bit of a higher risk, or at least that's how it's perceived by the lending institutions. So the rates are going to be higher to cover that and give them an incentive to lend to you. So there are pluses if you need them, but nobody gives money away for free. So if you're going to have to go along with a program like that, expect that there is a cost for it. And that cost could come to you through a higher rate, a more stringent qualification process. Not all lenders will cooperate and participate with the Maryland Mortgage Program, so it might take a few calls to find someone that does. And if you do find someone, you want to make sure that they know exactly what they're doing, because there are added administrative functions and underwriting needs that go into a loan like that. So you want to make sure that whomever you're working with has the ability to get a loan done for you in the prescribed amount of time, because it does add a little bit of time, generally speaking, in the underwriting and approval process. So you don't want to miss settlement date because you are working with a program like this. And then if you're lucky enough, you can be a cash buyer. So if you have five, six, seven, $800,000 sitting in the bank, you don't know what to do with it, you can buy a house with it. And so if you've got the cash, you can make the settlement more quickly, which will make a seller very happy. You don't have to worry about all of the administrative hoops to jump through with regards to the lending process. Closing costs are a little bit less. So if you have a cash to do the transaction, you can do that. Now, if you don't want to use your cash and your cash is tied up in investments, you can borrow against those assets, which for all intents and purposes is just as good as a cash transaction. You're borrowing from yourself. You're getting those monies at a lower percentage rate in most cases than you would if you're borrowing from a bank. So even though it may not be writing out a check from your bank account, it still is as good as cash. The benefit is you don't have to have an appraisal. Now, some people will. Some people will argue and say, well, I don't want to pay more than this house is worth. And we've talked about this before in other segments of these videos. The appraisal in a real estate transaction is not going to tell you what the house is worth. It's just going to tell the lender whether it's a good enough risk for them to borrow, to let you borrow the money at the price you're willing to pay. So I wouldn't worry in most cases about getting an appraisal unless you have evidence that says that that price that they want and you've agreed to is just outside of what the market would allow. Then yes, of course, getting an appraisal is a smart move. But 9 times out of 10, it's usually not going to benefit you, and it will just put one more thing against a seller that says, well, this other offer may be as good or better than yours. Now, there are cash-like cash programs. If you have equity in your current property, if you have a lender that knows and delivers bridge type programs, they can cover the cost of the buying and the selling with one main and one overall loan program. So you can act like you have cash, even though you don't in fact have the cash. And they'll work the value of your home into the sale price and work it all out. So you can present yourself as a cash buyer, even though you're not really a cash buyer. One thing to know about a cash buyer or a cash transaction is that the seller doesn't always look at a transaction that involves a cash buyer as, quote, cash is king. Cash is good. Cash carries less risk. If the money is there, there's less risk of settlement not occurring. But some buyers think that cash trumps anything else, and it just doesn't. The lending process these days is way more particular than it used to be. There's less risk in most cases of a buyer not making it to settlement than there used to be 20, 25 years ago. So while cash is looked upon more favorably, don't necessarily expect it to save you 20, 30, $40,000 in the sale price, because if the buyer has done his due diligence and the agent has done his or her due diligence and they've looked at and use a lender that underwrites prior to submission of the contract, someone who's borrowing may be just as good as cash. So don't get the idea that having cash, if you have it, is going to save you tons of money in the transaction, because it may not. But if all other terms are equivalent, not necessarily actually equal, cash can win out. It often does. And if you're in that position, then go for it. All right. And then, of course, we have some other loan types that people don't know much about and don't get used as much, but can be valid programs for you under the right circumstances. There are adjustable rate mortgages, there are jumbo loans, there are USDA loans. Adjustable rate mortgages have a period of time where the rate stays steady, could be 5, 7, 10 years, whatever the lender is offering. And then after that, the interest rate can vary. It'll fluctuate. It could go up, it could go down. When one gets an adjustable rate mortgage, one is betting that at some point rates will go down so they can refinance and get a better deal. That used to be something that was almost guaranteed. Now it's not so much, but it still could happen. And even if your rate just goes down a little bit, it could save you some money. And what some people will do is, since the adjustable rate mortgage interest rate is usually a bit lower than the 30-year fixed, they'll make that larger payment that would have been required with the adjustable rate mortgage, so that they bring down the principal more quickly. And at some point, potentially, if the loan allows it, recast it at the lower principal rate. Or when they do refinance, they've gotten ahead of the equity in the property than they would have, more quickly than they would have with a 30-year fixed. Another reason that an adjustable rate mortgage may be of benefit is if you really don't have the intention of staying in the property a long term. Most buyers around here, most homeowners, keep a loan somewhere between 7, 8, 9 years. And then either the property gets sold or they refinance. So having a mortgage for 20 or 30 years anymore is not the typical. So if you have reasonable expectation that you're going to move on sooner rather than later, an adjustable rate mortgage can save you money and can be the thing to do as an advantage over other potential products. And then there are jumbo and jumbo conforming loans. These are for higher priced homes. There are lots of different aspects about those. Are for higher priced homes, which is common in Montgomery County. The underwriting is more strict. In some cases, you can get a loan that is more favorable terms with a higher price because you've got a better down payment than it would if you were going more for the conventional side. So here are common mistakes when it comes to picking the mortgage program you're going to use. Choosing FHA when conventional is actually possible. Conventional, generally speaking, will win out because it's better terms overall than FHA, although FHA can be a fine option when you need it. Not exploring the Maryland mortgage program that's out there. Some borrowers can benefit from that. And while there is a higher cost associated with it, it can be the difference between getting and not getting a house. Don't focus on the rate, focus on the total cost. That's where people get jammed up a bit. The interest rate only tells part of the story. There are additional costs. If you get that lower rate, but you have to pay more interest up front, or there's a mortgage insurance component that you have to pay up front, you should factor that in because your overall costs could be higher. And you also want to make sure that you are structuring your offer so that it wins and dovetails with your mortgage program, as opposed to having it as a completely separate facet. There are more options now than there were 10, 15 years ago. At some point in time after the financial collapse, a lot of options went away. Many of those options that did go away were dangerous, and it's a good thing they did go away. But there for a while, we only had a couple of options, 20% FHA, and that was about it. Now there are more options. You have to qualify for them, your income and credit factor in, and there can be different ways of doing it. So take a look at your circumstances. Talk to a reputable loan officer, talk to your real estate professional, get all sides of all of the coins and decide which is best for you, and then make your best offer, put your best foot forward, and get that home of your dreams. All right, see you next time.